Hello everyone. I'm here to talk about our new AIF that we are launching, which is called Ambit Pricing Prowess Fund. This fund is aimed at niche long-term investors who are looking for superior absolute returns by investing in quality businesses with pricing power. Our investment strategy is designed to achieve our objective by minimizing the behavioral biases and the institutional imperative. There are 5 key factors which differentiates our fund. The first one being mindset, where our focus is to think more in terms of decades rather than the next quarter. The second one being process, where we have our own proprietary pricing power framework rather than focusing on stock price movement. The third one is the approach, where instead of being action oriented, our focus is more on buying the obvious or what we call the nuggets of gold. The fourth one being behavioral aspects, where instead of going by the comfort of crowd, we rather focus on conviction, which comes through years of practicing something, which in our case has been on quality and pricing power frameworks. And lastly, our risk positioning. Instead of being focused on asset gathering or relative performance, our focus is more on trying to see how we can create enduring long-term alpha and also on capital protection. Warren Buffett has a very famous saying which says that the single most important decision in evaluating a business is pricing power. If you have the power to raise prices without losing business to a competitor, you've got a very good business. Pricing power is one of the most frequently mentioned concepts in the business world and one of the most powerful factor investing style. Pricing power, or a company's ability to raise prices and maintain profit margins even despite of increasing cost or competition, is one of the most critical dimensions for evaluating any business. Pricing power can be of 2 key kinds. One is the differentiation advantage, where you are able to kind of have higher prices or kind of entice higher willingness to pay for a company. The second being cost advantage, where you are able to have a cost which is significantly lower than the industry-wide average, and it is very rare sometimes to find companies which have both these advantages, where they are not only able to kind of increase the willingness to pay, at the same time are so cost focused that their cost is significantly lower than the industry. So why pursue pricing power plays? Firstly, they are a great inflation hedge. Pricing power companies can raise prices to offset inflation, thereby preserving their real earnings and shielding investors from the eroding effect of rising cost. Secondly, they drive higher margins. Unique value propositions and strong brand recognition allow them to command premium pricing, which withstands competitive pressure. Third, they are stable quality compounders. They tend to be less glamorous and newsworthy, exceptions when they are at an early life cycle, and instead they are quiet and stable quality compounders. The fourth point being they have very low volatility. Strategy works across multiple global markets and economic cycles, making pricing power a cornerstone of resilient high-quality portfolios. Lastly, the value creation and premium valuation. The ability to have pricing power can support premium valuations as investors are willing to pay a high multiple for companies with predictable and sustainable growth. So when you get the pricing power play right, that's when you create the Lollapalooza effect. So the Lollapalooza effect in business is about getting multiple mutually reinforcing factors right. And this, in our investing style, we do by finding all these 6 key variables that we have, which kind of confirms whether a company has pricing prowess or not. The first one being that they should be dominant franchises, preferably duopoly, monopoly, or acting in sub-segments of an industry where they are the market leaders. The second one is the key one, where we want to look for companies which have a key advantage in what you call is the most important consumer variable, which should have very high variance. The third point being that they should have not only multiple moats, but these moats should be increasing in nature. The fourth point, which is again very critical, is we want management who are playing the long game rather than trying to play the stock market or trying to have a very short-term focus. The fifth point being that we look for companies where not only it's quality first, but we look for forward-looking quality as against static quality. The last point All these points, the first 5 points we mentioned, has to be in a way reinforced by factors such as, is the market share increasing, is the margin stability there, is the scale that we looked about is there. So basically all the quant factors, which is 30% of the weightage of our companies, has to be reinforced for all these points to clear. Our investment frameworks is divided between quantitative and qualitative frameworks. We give 30% weight to our quantitative frameworks, which acts as a reinforcer for our qualitative frameworks, where we give the maximum 70% weight. What we try to do is that each of the qualitative frameworks should in a way be proved or reinforced by the numbers which is there in the quantitative framework. When we have a company which is able to pass through both the bucket, that's when we find companies which have potential pricing power. While there are plethora of PMSs and AIFs which is supposedly focused on quality, we believe we are differentiated here because of these two key aspects. The first one being our focus not only on established pricing power plays but on emerging pricing power plays. What we see below is an exhibit from Professor Damodaran, where he talks about a corporate life cycle, where he says that just like a human being who goes on from an infant to an old man, even a corporate goes through different life cycle. And the position which we have marked in green is the stage 2, the late stage of young growth, and stage 3, which is high growth. This is the segment where you find many so-called emerging pricing power plays, where we look for factors where all the qualitative aspects are meeting, and sometimes the quantitative factors may not be there, that is, it may not have a 10-year history and so on. So this is the point one. The second one being our focus on forward-looking quality rather than static quality. What we mean by that is that while static quality is indexed to the past, we seek companies that will be successful over the next 5 to 10 years. We go beyond the conventional wisdom and apply our pricing power framework to identify companies which we think will be as successful over the next 3 to 5 years. Our investment focus is to find companies in the sweet investment zone, which lies between the late stage 2 and the late stage 3 bucket. Since pricing power is such a pervasive concept, we often hear people say that, if a company has pricing power and it's known, then wouldn't it already be priced in? And would the market then offer a consistent outperformance? However, there have been numerous empirical studies which shows that not only are these pricing power companies been able to historically show consistent strong returns, at the same time they have maintained a very low risk profile. Moreover, more importantly, these studies show that these pricing power companies have outperformed and maintained lower risk profile across different geographical markets and across different market caps, leading credence to the long-term ability of pricing power being a key investment factor for finding long-term returns. So unlike the industry, we do not view investing as a treasure hunt. We believe that the fundamental principles of investing are well known. Mankind has made progress by ignoring complexities and focusing on simple questions. Fundamental principles are well known, like the DNA is the common code of life, 7 primary colors are the base of the colors, and all music tones are based on 12 tones and 2 rhythms. So instead of reinventing the wheel, our approach is to leverage on the power of simple and obvious opportunities. Our investment approach is not that of a placer mining, the process of shifting through piles of sand for specks of gold. Instead, we attempt to apply our pricing power framework to find large, unrecognized nuggets of gold that sometimes lie in plain sight on the ground. Howard Marks has a very famous quote which goes like, "There are old investors and then there are bold investors, but there are no old bold investors." So in this risk positioning framework, he explains how one needs to always have a balance between defensive and offensive, so that one can aim for both capital protection and return maximization. We believe that the risk tolerance spectrum that an investor chooses depends on what is the investor's goal. If the investor's goal is longevity, then the leaning will definitely be more towards defensiveness and conservativeness. Similarly, if the aim is for rapid speed or a glory like a shooting star, then the leaning will be more towards high risk tolerance and aggressiveness. That's why there is again a famous saying which says that you can run a sprint or you can run a marathon. but you cannot sprint a marathon. We at Ambit Asset Management, we are more believers in longevity or the magic of compounding rather than trying to follow a strategy which would be about rapid speed or trying to be like a glory, achieve the glory of a shooting star.